Everyone to the Kendall Report, where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Tonight's video, folks, we've got a lot to talk about. War, oil, interest rates, the markets, the Fed. Let's get into tonight's video. Well, welcome everyone. It is Sunday night. We had quite the weekend after the bombing in Iraq. I got Iraq on my mind, in Iran. Crazy times, folks. I was a little upset because I didn't think they should go in there and do this situation, so I'm not going to go deep into my opinion on it, but I wasn't very happy about what happened here. I don't know. Yeah, I'll just leave it at that. I want to say some things, but I'm just going to leave them alone for right now. As far as this action and the markets go, it's still very uncertain what the impact was. They don't. Originally, I'm getting a little frustrated with the Trump administration on messaging and what they're doing here. I don't know. I'm not that happy with the administration from that standpoint because, once again, everything's perfect. We did it. It's 100%, all that. Within minutes, they were declaring victory. And now we know potentially maybe they hit the area in the site, maybe they demolished it or not. I was chatting with a buddy of mine, text chatting the other night after this happened, and we were chatting that, one of the things I said was, did anyone think about nuclear fallout? You just blew up a nuclear storage site, and is this Chernobyl times 10 or something? Obviously, there's no detection of any of that, so maybe it's so deep in the ground that it just all stayed there, and once again that happened. But anyway, let's talk about what I'm seeing here in the market reaction, and it's very muted. I was wondering, how are we going to open? Bitcoin was taking it pretty heavy. We were down over 3,000 on Bitcoin. Looked like everything's bouncing back, and if you recall, when I did the last YouTube video I did just before our little mini holiday, I talked about all of the algos suggested there wasn't going to be any big declines. I thought, is this the black swan that happens and the markets get hit and we decline sharply from that level? And the answer was no, not at least right now. And the reason for that is that, once again, there's just a lot of uncertainty, a lot of rhetoric around these events, and it's just what you hear is not what you're seeing. So we don't have any evidence of anything. Once again, it's sort of like the trade deals, right? Everything, we got trade deals and all these people are coming, but no one shows up. And so like I said, messaging, I'm giving a D-. I'm only short of an F on that stuff, but the market's reaction, I think, are the most important thing, and I think everybody sees what I'm talking about, and I think that's why it's being muted a bit as far as that goes. Crude oil, I'll go through crude. I'll cover the Dow. I'm going to try to go through a lot of this stuff, including going through the going through the. Excuse me, I get a bunch of stuff going on here. Trying to get, I'm getting errors on stuff here, so bear with me 1 second here. And yeah, okay, I got everything run, just got an error. But we'll go through all of the different elements here. But as far as any big reaction, we're down 0.4. I think crude was up 4%. It's already cut in half those gains, and it's going right up against some of the numbers that I talked about a number of weeks ago and what we covered the other day. So the technicals and the quantitative stuff is holding pretty steady to accurate right now, and it felt like it was a much bigger deal. I think that's maybe what was frustrating me the other night when this all happened, is it felt like a bigger deal, and people are talking about it. And of course, if Trump does anything, there's one part of the equation that anything and everything he does is wrong, and and so you got that element as well. So it's just anyway. So let's go in and just discuss a couple things. There's something I want to look here. I was trying to get set up here. I had some other things going on today, so let me just look. I want to look at something here that will help us out a little bit. I thought I had prepped everything. There's one thing I forgot, but yeah, I just think in general, what we're going to have to watch out for here is new news. Now, the other thing that's being talked about, right, is that the Straits of Hormuz will be shut down. I don't know. I thought that's already been decided, and I tried to come up with some estimates, and I'll talk about this more when we go through crude oil. But the whole idea, if you did shut down or change the flow, they can go around the long way, I guess, and it's a real long way, and it would raise the cost of oil. But I'm not even sure if that would be as disruptive as it was once upon a time, And you have to remember, U.S. has got a lot of oil here, and it's once again, who's this going to affect? It's going to affect Europe again for the most part, right? So that's where that's going to, a lot of the brunt of that is going to happen there once again. So I just want to, so before I go into this, I'll just discuss some of this stuff. We've got, typically, and I want to talk just about the after effects of the Fed too. So we'll probably go a bit longer. We may do a full hour tonight because there's quite a few things that are likely to come up. But the bottom line is I don't think the issue right now is going to be 100% focused on war. Maybe if something happens in the Straits of Hormuz, how does the U.S. react to that? Not one drop of oil that I could figure out goes through the Straits of Hormuz and comes to the United States of America. So if Trump is America first, then he should be nosing out of this whole situation, and that's kind of my position on this. If certain things start to happen, then there could be more involvement. I don't know where this goes from here. Nobody does, right? So let's just go to economics. Looking at this week, typically after the Fed, and I'll circle back and talk a little bit about the Fed. We get tomorrow. We're going to get existing home sales. That's an area that we have to watch fairly close because real estate's starting to take a pretty good hit here, especially with and it really has. I don't think it has a lot to do with the interest rates because they're basically where they have been. On new construction, there's a lot of buy downs and stuff like that going on. But we get that on Monday. We also get S&P Global reports, and no one really cares about those. I don't think anyway, but you got manufacturing PMI coming out. You got the services PMI. So, they're listed as high impact, but I don't think they're going to be that big a deal. S&P manufacturing expect to be at 52, still in expansion mode, 53.7 on services. And that's the backdrop, folks, we keep talking about for a while, is that, the economy is fine, and that's part of why, and I'll go back and talk a little more why the Fed did nothing last week, right? there was nothing to do. There was no reason to do anything. So we get home prices, we get FHA housing index comes out, and then we get case show or those things on Tuesday. Just looking at our new home sales, that's 690,000 is the expected number, and 690 to 700, and that's a pretty low number. That number used to be nearly double that once upon a time. So there is some constriction. The market has been pretty weak, and a lot of that happened. I think I don't really have an opinion on what's going to happen there. I think it's pretty much hammered down right now. We got durable goods, GDP third estimate coming out, and then we get the initial claims. And claims is kind of bumping up on these higher numbers, so we're seeing some weakness coming into labor, but nothing material. Let me see what the last report. Continuing claims was 1.945. So for me, anything over 2 million, then I'll start screaming, because the continuing claims have more of an impact. We get a little bit of a bump one way or the other on the weekly claims, but that's going to be the big number. Then we get PCE numbers coming out on Friday. So we'll finish the week on some inflation data. And, at the moment, that's not much. If crude oil were to bust, and we'll go through the details here in a minute, but if crude oil were to bust through $80, that would be a big deal from that standpoint. So let's talk a little bit, revert back, and let's talk about the Fed, and just kind of expand that. Last week was a short week from an analysis standpoint, so I'm trying to fill a little bit of a gap of missing out on Thursday night's markets. The whole situation with the Fed is going to be, I think, a non-event. I think the Fed, for all practical purposes right now, are completely irrelevant. They have nothing to say about anything. They must be making Powell really feel, like he's lost all of his power. And I think that's probably a good thing. I don't think there's anything that they need to do or they can do to change any outlook. They kept the same dialogue that we had before. And I talked a little bit about this on Wednesday night's video, but we're really, they're lost. They have no power whatsoever at the moment. If they lowered rates right now, would be incredibly negative, because then people would think, oh, there must be something wrong. But none of the metrics, we've got a decent week coming at us with some of the numbers I just talked about. We've got a decent week coming at us as far as economic numbers and feel and a sense of where we're going. And, I don't think we have any earth-shocking numbers coming out of anywhere, And then we got maybe, a few more weeks, so we'll finish Q2 here in a couple of weeks, and we'll start to talk about Q3 and 4. And these are areas that I think we're going to see some breakdown as we go forward. It's, once again, like I've been talking about, we've gotten up just above the 200-day moving average on the S&P, and what we're seeing here is just that steady rollover, just flattening out a slight roll. Like I've been saying, I don't see anything big on the downside happening, but there's just no reason, nothing to push the markets higher. And when's the last time you heard about a trade deal? I did see something kind of funny, and it was on X, that they had a thing that Trump's favorite answer for everything is, I'll be able to tell you more in 2 weeks. Probably about 2 weeks, maybe a month, but 2 weeks is his favorite number. And this goes back, somebody put a collage together of him going, I'll know more in 2 weeks. I'll know more in 2 weeks. So in 2 weeks, we'll have finished this quarter, and we will know more. So we'll as we come into Q3, we're going to start to see, I think, a better picture from earnings standpoint. We know they always cook the books on earnings, but maybe we'll start to see some softness coming in. I'm not sure. We've already determined that so far what the tariffs have had zero effect, as in 0.0. There's no effect on inflation. Everything that we were told as far as what was going to happen, none of that's happened, and that's typical, folks. I've told you folks probably hundreds of times over the years that if you want to be a good analyst, just fade anything that comes out. Like Ray Dalio comes on and he's bearish, be bullish. It's really, really simple. A lot of the mainstream stuff I saw, Paul Tudor Jones, who is one of my peers. Matter of fact, he went to college with a buddy of mine, and he's out there the same story, but he kind of sounds like me. And Paul and I have aligned many years ago. He used to get he got a copy of my old newsletter back in the 80s, in the 80, 85, 88 range. And I think one time he actually flat out quoted me on one of the things I was saying. But the point is that what we're seeing here is this gradual roll is happening, and it's just going to be. I keep talking about dog days. Well, it's June, so we've got really July and August, and hopefully it stays like it is now. The prospects of things getting worse with the war and things like that, that's just something else hanging over the market, folks. It's like nobody wants to be the bag man, right? So no one wants to come in here and buy this thing for expectations of new highs. So we'll just become and remain traders for a while here. Let me get the next screen set up. I just have something I need to get set up and go from there. Let me just see if anybody has any comments or anything. Yeah, Peter's asking what would be the effects of 90 deals in 90 days on the economy. Probably nothing. And that's actually a really good question. Yeah, I saw some of the folks going around Robo-Taxi in Austin as well. Just looking at some of your comments here real quick. That's a good call, Robert. That was right. It was 2 weeks to flatten the curve, right? That's excellent. That's really good. But what was that question that... Yeah, so this is the deal. No pun intended. If you got every deal signed up for trade, the economy is not going to change. I mean, okay, you got trade deals. All right. Maybe there's some bump, but it's going to take quarters, not months, but quarters of these deals to be in place. I know we just want that one little trigger where everybody's buying and we get that frenzy and having all that fun again. I don't think we're going to have that fun for a while. I think you're looking into really first Q1 of 26 is the next time you're going to maybe have anything that feels like that. And it would be nice to have retest the lows of earlier this year, or even make a lower low would be a much better place to come from for that excitement. But the reality is, even if you got all the deals in place today, that would not increase any demand or change the trajectory of the economy at all. That's been my argument all along. Everybody's talking about, we're going to the moon as they announce these deals. Well, they sort of kind of got to deal with China. What happens now with all this next level of noise? I think if anything that Trump's managed to do this year is create absolute uncertainty and no vision of the future. So that's one of the things why I complain about their messaging, is that they're really missing everything. There is, I mean, if somebody said, "Well, what are they doing?" I couldn't answer that question. I don't. They're talking a lot. Now we've thrown, a mini little war scrimmage in there, and that's happened. So I'll just go on for another second here, and I'm sorry to get things just keep coming up here, but that's the other thing. I did a pretty good study. I mentioned this to you the other day, that the average one of these, typically if the U.S. gets involved, then it's a bigger deal. But most of these deals that happen like between other countries, and especially out of the Mideast, is that the effects are about 2 weeks, and the average decline in the equity markets, is what I was researching, is about 4.1%. So they're pretty much muted. The only one that was deeper was in the Gulf War. That was a 17% decline. And we live in a different world now also, folks. We live in a much higher level of beta that we used to. We're looking at an elevated, because of the prices, right? To move 1%, the prices are much bigger, but we have a relatively higher level of volatility than we have in the past. So we've already had a 21% decline this year, and it's rebounded, and we're positive. So we have probably, if anything, set up the range. Like I was just talking about, we'll probably see some kind of a move back in. All right, so let me get set up so we can move forward here. And just want to get to the database here real quick. All right, so let's go ahead over there and take a look at that. All right, so bear with me 1 second, just want to adjust something. Okay, yeah, so if we look at, we're at, so while all this is going on and bombs are going off, the database is getting some moderate traction here. We had 630, we got 739 new buys. We got, on the exit side, we got about 230, 240 on that. We've got a bullish ratio on 1.2 and a slightly negative on the weekly too. On the, interesting enough, on the short term, we got roughly 1,100. I'm just rounding these numbers off. 1,100 sells, and we'll call it 110, 108 on the exercise. So let's take a look at what the percentage on the. So we're seeing an increase in buying coming into the intermediate database, and let me bring up this. And we're seeing a slight decrease here. We're at 70.51% on. So we were around 73 and change. So now we're seeing it come down. Like I've been talking about, I'd like to see back in the range 68, 62. So this is positive. We're seeing the longer term models are picking up stocks while the short term is selling, but we did get, nearly 75% at one stage here on the short term database. So had a lot of momentum, so now we're starting to see rotation on the short end, meaning that the signals that came in early on are starting to rotate out. And then on the intermediate, we've got well over the 52%. If I just go back to, just for the numbers here, we're at 53.26. So the next metric that we're looking for here is 58 to 62. And that would put us into basically in trend mode for the amount of stocks that are long. And I've talked to you folks about this before. When you're just looking at indexes and drawing trend lines on indexes, you're looking at really a subset of the market, because most of the S&P, for example, it's got 500 stocks in it, but the top 50 are, I think, close to 28% of the index. So they're material drivers. Of course, the Mag 7, all that stuff is in there. But beyond that, there's other material levels in that top end of the index. So all of the most of the indexes like NASDAQ and S&P, which are cousins because they have similar constituents in there, those things are weighted indexes. So you get that heavy weighting on the top end. And a lot of times we run in our models, we'll run the entire index, all 500 stocks, and have these massive portfolios that we run. And you can see sometimes what happens is you start to let some of that go and you see a back end rotation. And we haven't seen much of that yet. But anyway, the database is actually pretty healthy. You got the short-term bullish. So this is why I was arguing the last time we were together on YouTube and also in the Substack, is that we're really seeing that this rotation is building that foundation under the markets I was talking about a couple months ago when the intermediate database was well under 20%. So it started buying as the short term got more traction, the more buying that we saw coming in the front end, which is building that longer term foundation. The difference is most of the short term models are 35 to 50 day holding periods, and then you get a rotation. And then on the longer term or the intermediate, they're more like 180 to 240. So better part of a year once we get traction. Doesn't mean they all hold, but it does give us some forward-looking ideas that we're going to have more stability. So that's putting a bit of a challenge. I'm still sticking with the expectations of a Q3 and 4 slowdown, but the markets are not the economy. Okay, so we could see a moderate slowdown in the economy, and we could still see somewhat of a positive rotation in the database and how markets are responding to the development. So maybe going back to the question, what would 90 deals in 90 days make? Maybe that's enough of a foundation to at least keep the stocks, money flow into the stocks, and maintaining enough money flow to hold these indexes into a pattern that would be more like the best way to put it, more just a large, very large consolidation. I think it's consolidation versus a distribution, but the jury's still out on that one. Okay, so let's go ahead and get into the indexes. So that this will be fun. I've got the sheet run for tomorrow. It looks very interesting. I'll bring that up here in just a minute. All right, so here we got the S&P. If we look at the metrics, we've already touched over here on the right-hand side. I'll blow that up. We've already been down. Let me just see where the low is here right now. The low is 59.59 and STX 59.51. So we came right to STX and we bounced off of there. Current price right now 51.91. So we got 40 handle bounce. I actually did some aggressive buying when the market was down off of the open. I was just looking at crude oil, or immediately started fading. So looked like there was a trade there, which there was. So we're still seeing that from the curvature of the projection for the 10-period moving average, we're still seeing the market still trying to move back towards this 200. I still think that's what we're going to do as we come into Q3. More flatness, a move into the 200. Nothing's showing up here. I'm going to bring up the weekly chart here in a second. I'm just going to try to roll. I know I went on there was a lot to talk about and a lot of context that we needed coming into this week. But the it's rolling over. We still have that 40-day moving average under here, which is going to be the place to go. You know, that's going to be your main support line. If that bleeds off, it looks like maybe second week of July, we could see a bit of a rollover and maybe come down and test the 200. And the 200 has some potential weakness coming at it too. So we may get further challenges, but for now, that's an easy target to get to. So right now, the 40 period moving average is sitting here at, 40's at 58. Let me just blow that up so you can see it. It's 58.69, and the 200 58.47, and then we've got 59.77 is we're trading just right at the 21-day moving average. So that's going to be key. So, but pattern-wise, momentum to the upside is faltering. Looks like slight downside, probably testing the 40 at some stage. It'd probably just take one news story out of the Middle East to actually move it down a notch or two. Let's take a quick look at the weekly. Weekly, we got that big V bottom, but we're also seeing right here is where the 10 is suggesting that we're going to come back towards the right here. Let me get a value here. 58. Yeah, here we are. 58.65. That 40-day moving average, or 40. Get it right. The 40-week moving average is coming through here. That's going to be your support line. And I'm going to go back to the daily for a second because that line, the 200 is, just to show you this, the 200 is 58.47. And the reason why I chose 10, 21, 40, and 200 moving averages is they all, if you start top down like with a daily and go to weekly and monthly, they all integrate together as one. So you can do bottom up or top down analysis from this. So just going back to the weekly, what this shows us is that we get the 200, the 40 week is very similar to the 200 day that is coming through here. Like I said, that is 58.62, it's 58.47 on the 200. So that 58.62, 47 is going to be your support range, and that will set things up pretty good. What we're seeing here, though, is a pretty big drop in the potential for the momentum. And let me explain something about these algorithms. So the algorithms have a look back period of, in this case, of 150 weeks that's compiling. And this little big decline here is right now suggesting there's an echo of this to come back in. And typically, because of the values are here, you come back into the moving averages. It would look like it's very bearish, but indeed, all it's doing is telling it we're coming back into this moving average range. So even though it is weakening, the weakening is somewhat softer. Now, if we get to, if we come down at the bottom here, the 200, in August, it starts to falter, and that typically will start to bend things down a little bit more. But it's way too early to make that call, and there's no point to it because we can't trade 3 months from now. We got to trade to the 3 month period. So from a trading standpoint, we know we have support at the 40 week, 200 day, and also the numbers I just showed you. So this is going to be, so I've set this up. So I'm going to show you the numbers on the NASDAQ, but the analysis is the same. The patterns are very similar. If there's any slight differences, I'll point them out. So let's go ahead to the NASDAQ. So NASDAQ, we'll go weekly, then daily. NASDAQ, same pattern. That's what I was telling you. The only thing that's happening here at around mid to the last week of July, we're seeing the 21 has kind of an echo bounce. This is why I'm targeting this moving average area. So let me just blow this up just a bit. So what happens a lot of times when you have these moving averages will come, you can see the red dots are forecasting us below the 10. Right now, if I just look at the value on the 10, we're at 1.59. These are very bullish numbers. So this is my argument against any kind of big declines. I thought, well, there's going to be a challenge maybe with all this news out there, and the answer is no. Markets they're not resilient. They're just they just don't care about these events, and that's what I've been discussing when I did the results. The bulk, like I said, the bulk of these type of events right now, if they do not escalate, are anywhere from around 2 weeks. So if we go to the initial hit that came in when Israel bombed Tehran, that we're coming in this Friday be right at that 2 week mark. So, and like I said, the average decline was I believe it was 2.1%, and the maximum average was around 4.1 on all these events. The only one that really was bigger was the Gulf War. That was a much bigger situation for whatever reason. Okay, so let's go to daily real quick, just to get that look. Daily STX 21,546, low 21,566. So if you have the indicators, you should have been looking for that number before I came live. The markets opened at 6 New York time. So I'll try to finish quick if you're an NBA fan. I know the Game 7's on right now. So hang with me. We'll make it worth I hope you got the DVR on. But all of these patterns, S&P, Nasdaq, are exactly similar, and we're seeing that same decline. Now, the only thing that's happening here, the difference, and a lot of times in the Substack, I'll do a comparative analysis. What we're seeing here is there's a bit weaker tone being projected out of the daily PPM2, which just tells us that everything says we're going to the 40-day moving average. So remember this about the 40-day target. It's rising every day, okay? It's still in a positive upslope. So while we're looking for it, they're converging. The price is coming up underneath it. So make sure you watch that value. Don't look at it today and say, well, I think it's going to go to whatever price that is. Let's just take a look at that. Yeah, it's 21,107. Well, that number is going up every day. Let me just give you a number and how you should look at this. Yeah, so it's going up about 60 handles per day. Now that number is flattening out, so it'd be 60, maybe 55, 40, but every day it's moving up. So if the market goes sideways, the 40 will come up underneath it, and then depending on the configuration of the PPMs, then what you'll get from that is the PPM will get 3 will get weak enough, and you'll roll down to the 200-day. So everything points to 40 as first support level. That's first defense level. Next level would be the 200-day. And at the moment, none of the weeklies, nothing. Our database, which has 52%, half of the stocks are in bullish mode or in trending mode, not just, that number is not a bunch of stocks and things that are above their 200-day moving average. Those are things that have been determined through a logic of about 60 rules and almost 600 variables are going. These are trend mode, or otherwise they're trending stocks, not just stocks that are above some value. You can be above the value and still be weak. You could be declining towards a value, and people go, oh, it's still above the 200. Well, it's declining though. It's in a downtrend, so it's probably going to take it out. So in this case, we're seeing the opposite, where we have a lot of stocks trending. Right now, we're over 10. There's 14,000. I think we're about 8,000, almost 8,000 symbols that are in trend mode to the upside, suggesting that over the next 120 to 200 days plus, they're going to be trending in that direction. So we have that foundation I'm talking about, but that's why these indexes look like this. All right, so let's talk about the rest of the show tonight. I'll go ahead. I'll go to crude oil. We'll touch on the treasuries real quick. We'll hit gold, and maybe we'll look at the Dow, because that's going to be in place. So I'll do it. Let's reorganize. I'm going to do crude oil, the Dow, treasuries, gold, Bitcoin. And just remember, folks, I told you, if you see anything that looks like 99,000 on Bitcoin, that was the point to buy. And we have bounced off of that, right out of that range. I think we printed 98.4, but that was your bargain basement price at the time. So let's go ahead. And I think when we go through crude oil here, you know what? I'm going to do something. I'm showing you crude here. But let's start with, let's do the Dow first. If I can type. Okay. So Dow this is something I was talking about. This is daily, that we're finally coming into a bottom. We actually have some fib targets on the upside here, pushing 101.7, let me just get the actual numbers here. I'll blow them up so you can see them here. They're over on the right-hand side here. So 100.22, 101.22, and 101.884. So we have a bit of a uptrend flowing, and you can see ultimately as we come into August and beyond, the Dow looks like it's going to be strengthening. Now these forecasts will change depending on what happens here, but this looks pretty good. I'm going to just go quickly through these stocks through this next sequence. And so this is what many weeks ago I was talking about, where we were seeing the projection. If I were to do a replay here, back in May when I was talking about the Dow, I said it's setting up some kind of bottoming pattern, and we should start to come in. It's forecasting that we're going to be able to get above the 10-week moving average, ultimately towards the 21, which is that 104.5, 104.7 number, depending on how fast we go. So this, and we should layer our way back ultimately towards 102.5. All of the algos, well, I shouldn't say all of the algos. Let me reset something. I've got an issue going here. Yeah, so as we look at the expectations here, the red dots are telling us we're going to go to the 21. While we're going to the 21, it doesn't mean we're going to go to 102. The 21 is going to come in play around that one of those daily targets I just talked to you about. So that there'll be resistance there. But we look at the momentum on PPM 1 and 2, everything is kind of pointing us to come up into one of these crossing points. I'm just going to show you. The dots here are the forecasted lines. So the 40 is forecasting to come down over here, and the 200, which moves much slower, this is I forgot what I was working at. Yeah, the weekly. That number is actually suggesting that we're going to get a crossover here. So this big 40 line is going to be your trend line. So ultimately, I think we just trade up into this resistance and then we just work our way into this little triangle formation around these projections. Because once these moving averages start in a range, and they're going to go somewhere close to that number, and this is using the ppms to forecast. Sorry, this wheel is very sensitive. So Dow looks like it's in pretty good shape. All right, so now let's do treasuries, and then we'll do oil. I think that'll be the right sequence to do these in. So treasuries, interesting enough, one of the things that I'll reference, excuse me, I'll reference what Paul Jones was saying. He thought, crude oil is going to go up big, interest rates are going to go up. Forecast is just the opposite. That's why, Paul's a really good trader, made a lot more money than I ever will. But the point is that that's the perception of this event, that we're going to get all these different things. So I've talked to you folks about this reverse fundamental. So his reverse fundamentals, what he's doing is, I think oil prices are going to go up. So the things that I believe will happen is that there's going to be, the straits are going to get closed. And I think he stated it's like you're going to see oil at 100, 120. And that's one of the sides of the street that's what you're going to hear probably almost from everybody. If you watch CNBC, any financial show, read anything, that's what you're going to hear, is that. They're also going to hear, because of that, interest rates are going to go higher. And the forecast I'm getting here is the exact opposite, is that we're going to see stable to declining interest rates. This is a weekly chart I have up for you right now. And everything is starting to flatten out. I don't think we're going to go straight down here, but this is December over here. And that number in December is 395. And if you folks have been hanging around me for any time at all, what's the range I've been telling you? 395 extreme on the upside, around 450 on the upside. Right now we're 440, 438. So we're going to continue to hover around there probably through most of the rest of this month to the end of the quarter. And then maybe as July rolls in, maybe we'll see some lower values come into play. And this goes back, I'll just mention the Fed again. This is why the Fed doesn't need to do anything. And I think a lot of you seem to think that the Fed is controlling the rates right now, and I do not believe they are. I've proclaimed almost 2 years ago now, that the Fed no longer wants to be in the micromanagement of that. They want the markets to guide. When I started in this business, and if you look back in the late 70s, I started in 79, what Volcker did something different, but if you go back to pre-79, even with the worst Fed ever, Arthur Burns, he at least, for the most part, allowed the markets to lead the way. And if you went into like William McKesney Martin days, he was Fed chair from 1951 all the way to 1970. He definitely played this role that I'm telling you. And this is what I heard probably, I'm losing track of time, but maybe 2 or 3 years ago, I heard Powell say, this is what they're going to do. He said, we're going to operate in a much different fashion. And for the most part, other than his political moment last September, where he lowered rates for no reason at all by 50 bips, maybe there was a reason in hindsight. They were too high to start with. But the bottom line is they wanted to get into more of a yield curve management, and they also wanted to allow market rates to drive their actions. So what the Fed used to do back in the day, and we'll say pre-Volcker, pre-Greenspan, all that, is the Fed would watch the market rates and then they would adjust the rates to the markets. They wanted free floating and market rates to drive everything. And that's how it used to work. And I think we're sort of back there right now. I don't think Powell's going to do anything. The long rates are going to stay this 395 4. There's no reason for them to change. That's the average. If you went back, the 10-year note average, I think for the last 30 years is 6%. So we're still sub the average as far as the long term goes. I used to tell the story. I won't go deep because I want to be able to finish. I'm already late in the cycle for today's video. Is that, I think it was 1983. I got a house in California. My mortgage was 13 3/4. I thought it was a good rate because we just came out of 25% in there where you couldn't really even get a mortgage of any sort. It was like a credit card debt. So that was like a great deal. I was all over that thing. So matter of fact, the house I was buying, I did an interesting strategy. I did a lease to own. I had a 1-year lease to own because I was playing the interest rates. I thought rates were going to go down a lot, and they did because they were they were probably 17%. So while I rented the house, I had an option to buy. As it got closer to that, I was able to get a much lower rate by playing the market that way. Everything's a trade to me, right? So, but this is probably that range is going to be the max. 450. The thing that changes everything that we don't know is that if there was some kind of big event, we certainly have all the geopolitical little ducks lined up for anything to happen. But right now, markets don't appear, the forecast isn't that way right now, especially if we look at what's happened. Let me do one more thing because this will tie together with, if we go back, this is right here, this is back to 22. We're going to see, you can see all the way back to October of 22, we've been in this 4% range. We had a couple spikes up, but basically the range is on the bottom side, with the exception here in 24, got a little lower. It was almost like stair stepping. Now really the extremes are, we printed up to 5%, and this is 340. And I think that, like I said, I'm looking at 395, 440 in the range. We do have some live Fibonacci targets, and this is a weekly target. There we go. This weekly target range. So anyway, all right. So I got a couple markets to get through here. So we did the Dow. Let's do crude. So it was interesting. Some of you may recall, if you're regular on the channel, we were over here on May 27th, and we got these fib targets here, these green dots. And I said, well, we've got 3 fib targets. Not sure what would make them go there, but I always mention them when they come out because they get hit a lot. I said, typically we'll hit one, but look at this. The range on this thing, the fib targets, high-end range 78. Let me bring that up on the side here so you can see it. Got 78.16. And I just remembered, folks, I was so roaring down the trail here, I forgot to show you the S&P sheet, so we'll do that here in a second. I know it's out of sequence. That's very frustrating to me. But anyway, 78.16, and the high today is the highest part of the sequence, 78.40. So we basically hit that, satisfied that fib target. And if we look at the algos are going to stay bullish. So we'll say into September. Looks like maybe a breakdown as we come into August. So it looks like maybe we'll still have a positive slope. Maybe we'll do some consolidation in here. And so there's still potential to challenge this 200, which is basically what we've done here. If we look at that, that's at $80.10. So if we break above this 200, that could get us a little bit more of a run. We'll just see what happens. But so crude oil is going to stay positive at least into mid-July to early August, and then at wherever the prices are. So I'll update that. Right now we've satisfied the objectives. I would say there's a fair amount of resistance right at this level. 80.10 would be your pivot. So if we get above that, you could definitely get some more traction. And we're in that environment where that's easy to do, where we get an upward channel on crude oil. All right, let's do gold. So gold just keeps telling the same story. This is a weekly gold. And as I told you I would do this, so I'm going to really, before we do gold, I just want to publish this sheet and bring up the S&P. I know I'm way out of sequence. I apologize. I wish I could see the chat line better. Maybe somebody reminded me of that, but we'll see. So bear with me one second here while I get this up here. All right, so here's the sheet for the S&P, way out of sequence. Look what it's telling us. 60% bounce attempt, S2 defense success. So I ran this when the prices were down 32, handles were down 25, so markets improved just a little bit. When I ran this earlier, we'd already done 43,000 contracts. We're looking oversold bounce, held 59.88 at the time. I think we may have just penetrated that shortly. S2 support. This is interesting here because I want to bring this in just a little bit more here. The PPMs were neutral on PPM 2. PPM 3 is actually maintenance mode, and PPM 200 is neutral. And we have, basically it's neutral because we do have a negative PPM 1. And the thing is that we are below the second derivative, which is 0.15. So let's take a look at the range expectation here. So one of the cool things on these sheets is showing me that we're the target, it's even got a little target it put in here. You can see that. But it's flashing because this 6,007 is the target. We're trading 92. So it's giving us 70% probability to trade up to that level. So that's good. Let's just see, buy bounce 59.90. So that's giving you the buy bounce current zone. Target 07, so you got a 17 handle move, 85 with a stop. And then there's a breakout trade, which is over 6,008, targeting 42. I have a sense that we might see this be a pretty good trade in here. So watch that out. I'll rerun these charts later tonight when I do the Substack. If you haven't got the Substack, go to kendallreport.substack.com. It's $8 a month. And to the end of the month, we only got a week here, so you'll be able to get an annual price of $80, and that makes it like $650 a month or something. So that's the way to go. So get that summer special, I guess we'll call it. But these sheets that I show you every night, you get in the Substack, by the way, you get S&P, Nasdaq, gold, and possibly I'll put in the crude oil tonight, and you get Bitcoin. Okay, so we're pretty close. I'm going to run over just a minute. We just turned to 1 hour for the stream. Thanks everyone for hanging out. Make sure you hit the like button and subscribe. So let's go back to the charts here. Now we'll do gold, and we'll do gold and Bitcoin, and we'll call it quits. But this gold chart, it's interesting. We got this big collapse in momentum, but this was, even though I talked about this forecast been out there, even at its worst level, it was still going to be positive. So this angle of attack is really playing out here pretty good. We've got this nice, you can see the red dot forecast. This is forecasting the closes and the price range. My guess is if we close higher today, we'll see this grid turn back up. And this was, if we go back many, many weeks ago, you folks will remember I was talking about this big bubble formation. I said we need to normalize before we make the next move. Well, we've normalized. We also, if we go back a ways, if I go back to this this target zone, hang on. If we go back to this target zone, the indicators were telling you back in December of 24 when we were at, let me bring these numbers into play. December, day before Christmas Eve, we were trading 26.23, and the targets on the weekly range was for a minimum. If we look at the fib targets here, fib targets were 33.46, 36.54, 38.44. So we've satisfied fib target 1, and that's and we still have live targets here for those other 2 levels. So I believe you can see this angle that's being projected. Gold is just has been the best trade. I think it's a better trade than what Bitcoin has been, although both have been really consolidating here. And I saw another clip of Tom Lee. That guy, man. Anyway, I'm not going to say anything. I'm going to be nice. All right, let's do Bitcoin, and we'll call it quits. I guess if you're bullish Bitcoin, you gotta love Tom Lee, right? So, all right. So let me go to the daily, because this is what I was telling you. If we come back out here, there was some fib targets on the downside. Those targets were 99. Let me zoom in so you can see them down here. 99, 13, 94, 595, 592, and 91, 860. I said I don't think we get below this, but if you see anything that looks like 99, you want to buy it. We're now trading back at 100, so we do have a decent downslope that's formed here, and if you get the Substack, you'll see there's been some pretty negative, the last 3 or 4 reports that came out, especially out of the data sheets, have all been projecting lower down into this 99 number. Now it will be, and this was the other thing that I talked to you about, is that Bitcoin is an absolute risk-on asset right now. That was where all the action was in the over the weekend after the bombs were dropped. So we saw lots of range expansion here. We got a little bit of volatility blow up. What I would look for is if we get a higher close, we happen to get a higher close today. This thing just started a new bar just a few minutes ago, so this is the beginning of the new day. So if we get a higher close today, tomorrow will come in, we're probably going to see Bitcoin with an upward channel is probably going to click that market grid, and then we'll start to see some stabilization. But everything's going to be driven right now. PPM1 is a minus 0.508. That tells you there's only about a 20% probability for it to trade above the 10-day moving average right now. And I'm just, yeah, so that angle of attack is pretty steep here at 0.5. PPM2 is 0.22, so it's almost, the 21 is rolling over. So what it's telling us is that we're probably going to be able to rally. There's not a big trade here, but there is a trade up to the 10. 10 is declining. Market's going to move into that, and we'll probably get a retest of the lows that we had over the weekend. So that's how I would look at that. So looks like lots of activity on the line here. Let me just look at a couple, see if there's anything jumps out at me. Let's see, there's an interesting number here somebody was putting out there. Yeah, so somebody's talking about Robotaxi. Don't know much about the event. I did see some videos hanging around the internet that people were hanging around. So I'm thinking about this. Here's a question back to you guys on that. If I have a Tesla, I'm not sure I want a bunch of grimy people riding in my car. I mean, is that going to work? Maybe I'm just old. I'm not thinking, yeah, I'm going to get a bunch of smelly, dirty people and I'm going to throw garbage in my car to make $5 a ride or something. Elon or somebody was bragging. It's only $5. I don't know. What do you guys? What do you folks think? It doesn't sound like good. I don't want somebody riding in my car. Maybe it's a good business for Tesla, but for the individuals, you really want. Theoretically, you're going to sleep and your car's going to make money. Nobody's using a taxi in the middle of the night. But anyway, I think I've seen a lot of the Waymos around, but they also have a safety person in the car to override. So it's the same thing. I saw somebody talking about the Waymo stuff. And if you're down in Phoenix, Arizona, you see a lot of Waymos around, okay? In Phoenix, Scottsdale, around, and around the whole valley, actually. And but there's intervention that even on anything goes on the highways, they've got someone in there. And then anybody that's, they have oversight that they're doing. I think they have operators like, maybe somebody's experienced it. I'm not quite ready to get in there. And are you willing to get into a car and sit on the driver's side with no driver and fling your body down 60 miles per hour? Just a thought. This old guy, I'm not ready for that. Maybe you younger folks are ready for that. But that's so. I see Peter Fields was saying there are no deals. There are no deals, exactly. And I've been screaming about that for a while, as the UK deal is not a deal. It's a partial deal. So Trump wants to claim victory on everything. Let me just look through a couple more responses. Yeah, listen, I'm just frustrated. You have to realize this is the right thing to do. I'm not sure. I mean, I actually think I am going to make a comment about this I think Netanyahu, I think he knew Trump was going to get a deal with these guys. And so that's why he intervened and went in there. I don't think Trump liked that. He kind of sucked the U.S. in there. I think they would have probably got a deal. Was that the right thing to do? I don't know. And I get there's two sides of the coin. I was just a little frustrated to see it going. It's not like it was a war. I just felt like, if you negotiate with people and then, then you shoot them in the middle of negotiations. I know. I guess all the, by the way, all the taco people are going to be gone now, right? No more tacos. Trump didn't chicken out this time, so we'll leave it at that. Let me just look at a couple more comments here. Let me go through. Yeah, okay, yeah, let me look because there's some good stuff you guys are talking about here. So we'll spend a few more minutes together. Crude oil's price because of panic or supply risk. I don't think there's much of a supply risk. What I've been able to find out, there was a couple pretty good spaces around it. There's a guy, a professor guy, he's an Arab, and he went through some things. It was pretty good. I don't think there's much of a supply risk. The rumor is, or maybe fact, is that China is overflowing, and their biggest customer, Iran, is China. Yeah, I mean, maybe 96, 97. I'm not sure it'll get there. We'll find out. Yeah, well, so Bo is asking, what if you rent a sheet on a weekly basis? I can do that pretty easily. It just gives you a wider range, and it's just a different analysis. The dailies are for really day traders and people like that. So um, I tell you one thing, I'm seriously stuck in a loop on getting that sheet out to everybody. So that's a frustrating thing for me. But yeah, you do that, it definitely give us less noise. Um, yeah, Natalia, maybe buy one for yourself, one for RoboTaxi. Um, you know, I maybe though they would be pretty good around campuses. Might be a good place. As long as it doesn't snow there, pretty good. So Texas, Arizona, California, most places um, are going to be okay for having those. Yeah, that is true. Ian, lots of drunk people use taxis in the middle of the night. Yeah, you're right, but not that many, right? There is some. Not that every Tesla is going to be that. Yeah. Yeah. Just let me look at a couple more and then we'll finish up here. Yeah, and I kind of feel the same way on the um, on the bombings. I have mixed feelings. 5 minutes from now, I might go, well, maybe it's okay, and then I'm just kind of back and forth on that. Um, let's just see here. There's one more. Yeah, so Tim said he did a driverless in Phoenix. Yeah, they're they're quite prominent there. There's quite a few of them. Um, yeah, a quick story. I was on Scottsdale Road at rush hour one day. I mean, it was jam packed, and this Waymo came across uh, was trying to go across it was trying to go to a hotel to pick up somebody, and there were three lanes of traffic on Scottsdale Road. It was trying to get across. And it was interesting, and I was back in traffic, so I got to watch this. I thought, let's see if it hits somebody, but it actually got its nose out. Somebody stopped, and everybody stopped and just went right across. I was really impressed, and I don't know if there was a remote driver involved in that situation. That would be interesting to know for sure. Okay, let me look at. Yeah, the Gen Zs take it like a duck to water. Yeah, you're probably right. That's probably right. Okay, folks. Well, listen, I really appreciate it. We had a nice show up tonight. I think just in closing here, I think things look pretty stable. I wouldn't be surprised that, like I said, on that trade I showed you on the S&P, that probably is a decent trade. If there's a trade from around here, I'm watching this thing. Uh, around the 52.90 to 60.07. So, and this is another thing that's happening real quick on just on the S&P is I've been talking about where we come down into the mid to maybe from 59.70 down to 59.50, 60, and we bounce back over 6, and we've been edging this up, so now we're back into the range again, and there's really good solid support around here. Like I said, the extreme is like 58.50, 58.70. So, you're looking at trades off of these levels, but the breakout trade, I'm kind of intrigued by that because I could see with all the negativity and all the expectations just on a contrary trade, right? That the markets are in position where they could go positive tomorrow. And that would just blow everybody's mind because how many people think this is so negative, and you get everybody and get some short covering. So that trade that was coming out of the sheet here, in fact, I'm just trying to find something here real quick. That's why I'm not seeing it. I'll bring that back up while I'm talking about it. So this trade down here that I was talking about, this is this, what? I think this is the wrong sheet. Sorry. Ignore this sheet. It was the wrong sheet here. Yeah, I got so many tabs open up here. It's ridiculous. Typical of me. Hang on. This should be it. Yeah. Sorry, I brought up the wrong sheet. So just to bring this up, this breakout entry at 6,008, target 42. If you get triggered in, you got to stop at 59.98. I kind of like this trade setup here, and right behind me here is the trade bounce, which is right here from 90. So that's probably, we're trading 91 right now as I'm speaking. So I think that could, those trades have some promise just because we've already hit STX on there. Like I said, one of these days, very, very soon. I thought I had 4 days to get this done, and I stayed up very late a couple of nights ago trying to get this thing finished. There's an issue with distributing this file right now. So anyway, maybe what I'm going to do is do a beta, and I'll reach out to some of you on Discord, and maybe we'll put a couple files out there so folks can actually maybe try it, so I can troubleshoot. My biggest concern of putting a sheet out there is that there's a couple little quirky things that you need to know how to fix and know what they are. So I need to make a video on that so you know how to do it. But I don't want hundreds of emails and things that I'm not going to be able to respond to very good. I'm also considering when I release these sheets is that you'll be able to get, I'm going to maybe do a once a month review of that. Maybe we might do it in a private Discord, something like that. I'm working on a couple of things, folks. So anyway, bear with me. Thanks for hanging out for an hour and 20. Appreciate it. And we'll be back tomorrow night. Get the Substack, kendallreport.substack.com, indicators at kendallreport.com/indicators. See you folks later. Have a great evening.